and starting to see some very interesting move in the markets following yesterday's Fed rate meeting. We're going to talk about that and what may happen with euro dollar, but also, of course, talk a bit about gold and other markets that are moving in relation to yesterday's meeting. Now, if you're new to this presentation, my name is Alejandro Zambrano, and I'm the Global Chief Market Strategist with ATFX. Before joining ATFX, I used to be the head strategist or chief strategist at the large Middle Eastern broker called Amana Capital. And before that, between 2009 and 2016, I used to work for the website Daily FX, and at the time, probably the world's biggest retail forex broker, FXCM. So I learned quite a lot about the markets, and what I try to do in these videos is just to provide traders with levels and ideas which I think are interesting in driving the markets and support really traders in their own trading. And that's it really. So I hope you liked the video, and I hope you also subscribe. Let's begin. Now, what happened yesterday then? Well, if you look at the actual statement published by the Federal Reserve, it wasn't necessarily dovish, it was not necessarily bullish. However, though, the statement was definitely interesting, and I saved a little clip here, see if I can find the quote by the head of the central bank. So the head of the central bank, Chairman Jerome Powell, he said, "We think our policy stance is appropriate at the moment. We do not see a strong case for moving it in either direction." Now think about that for a minute and remember what we talked about yesterday. So yesterday we looked at the expectations for the Fed interest rates by the end of the year. And yesterday they were projecting about 3 rate cuts. Not fully priced in 3 rate cuts, but I think it was about, well, actually we can see it here, about 3.8% likelihood of 3 cuts from the current rate, and there was about a 17% likelihood of having at least 2 cuts. Now, I know that this was slightly higher at one point during yesterday's trading session. So you had about a fifth of all traders really anticipating 2 rate cuts. And then you had a solid 40% saying that, well, actually, yes, about a solid 40% said at least 1 rate cut. And I think at one point, the expectations of having rates unchanged was just at a mere low 35. So the market extremely bearish, but obviously the guys that are in charge are the Fed. And the Fed are telling us right now they don't see a strong reason to either increase or to cut interest rates, which I think, again, makes perfect sense and something I've been talking about for quite some time. And we saw directly the effect on the euro. You can see the market was all the way up here. And if we take a look at the 5-minute chart, you can see that as we initially moved up on the statement, because the statement itself didn't really provide any, I mean, I don't even know what people bought, to be honest, but they did buy. And then here around 9:30, as the press release got going, we saw that sharp decline in price, because clearly the market is getting it wrong, as I've been saying lately. We can already see that it's not like a secret. Look at the S&P 500. It's at a new all-time high. It was at a new all-time high. So of course we can't. This market has moved also ahead here, and you have all these perma bears literally saying, "Oh, but where's that recession?" Well, there's no recession coming right now. It might come, but it hasn't come for the last 5-6 years. You've been telling us it's going to come, and it doesn't look like it's going to come right now either. Of course it's going to come at one point, but we're not there just yet. So I think what's happening in the rates market is that at the markets, this market has not adjusted at all the same way as the S&P 500 has, and people are just looking at the rear mirror and sort of projecting that we're gonna have a recession. And they might be right, but guys, it's always about the risk reward. When it comes down to trading, it's about the risk reward, right? The likelihood, for example, starting to price in 3 rate cuts in a situation like this, how do you start to make money? Well, if they actually cut 3 times, or if the people start to price in even more rate cuts. So it's always that balance that you need to look at when trading the markets, and it feels like most people got it wrong so far. Now, in regards to the euro, again, as I said yesterday, you have the macro view, and a lot of people, what they do, they just trade on the back of the macro. I remember a few years ago, 2014, 15, 16, everybody's like, well, the Eurozone is going to disintegrate. Disintegrate. It's not going to exist. France is going to leave, or Italy's going to leave. They have to leave. Yeah, of course, maybe it would be better if Italy and Spain would have left, because they can control their own monetary policy and sort of have more power over their situation. And the problem with at that time is that sort of Greece, Italy, and Spain were growing at a different pace, and it was in a different stage compared with Germany, France, and Northern Europe. So that was that problems with the matching. However, though, again, well, that makes perfect sense, and it's something I even learned at university when I was like 18 years old, so many years ago. Even that, if on paper the EU system from an economical point of view doesn't make sense, we need to remember it's a political project. It's not an economical project. And that's where, again, a lot of people get it wrong. They continue to tell you, oh, you should sell the euro because, the EU is going to come down crashing and burning. Again, because there's a political will there, it hasn't. And again, it's been something people have been talking about since we had the financial crisis. So 10 years now, nothing has happened. Well, UK left, but UK was probably one of the big beneficiaries from the EU. So it wasn't really one you would anticipate would have left. Again, from an economical point of view, politically, we all know why they left. So that's important to remember. And all of that, why does that matter? Because the technicals here, again, we have a nice reversal candle in the euro versus the USD. Market went down, and it looks now that we sort of probably are not going to trade much higher than 112.65. I think if we go up, I think people will try to sell, and we might potentially revisit 111.64. But unfortunately, this is not where the action is at. We need to take the idea, marry it with the right technical setup. And I think that's where gold prices are far more interesting. So from gold prices already that we have a massive head and shoulders, left shoulder, right shoulder, and head. We already know that we talked about that break. And the way this is looking right now, if one would have just kept the stop loss just above the break of candle, you would have been perfectly fine. Now, it's fine. Sometimes things like this happen. But you can see here, for example, yesterday we had the completion of the head and shoulders. If I show you 1 hour, you can see it better because you have a tiny head and shoulders here as well. You got yourself a head, left, right shoulder. And the first time was a failure. Second time was easier. So this would have been actually an optimal short level at 1277.62 and maybe putting stop loss just above the high. Now the way this is looking, the short-term trend now has resumed. It doesn't have to trade much lower. I could be totally wrong about the markets and the Fed. Maybe the non-farm payrolls on Friday is going to be horrible, and maybe people are gonna maybe they will cut rates. Maybe it doesn't, it's gonna go down. But the odds now for this trading lower has definitely improved. What I would personally like to see, I would like to see a retest of that breakout point. So maybe the market hitting up to something like 1277, and then from that 1277 level, I think people might potentially start to sell again. I'm just going to clean up this chart so we can see what we're doing. So maybe if we revisit that little level, like that would 1276, that would be probably enough. And then just being bearish about 1289, and that should hopefully be sufficient. And yeah, maybe we'll go lower. There is an alternative, and that is that we just take out the low here, and then that's gonna be the beginning of something as well. But reward ratio becomes less good at that point. Let's move along here, and let's take a look here at the GBP. Now, the GBP now, in the light of what just happened, it's a little bit more problematic to sort of know exactly what's going to happen. Again, with the euro, I'm not going to touch that for some time. I haven't done that for like a year or so. I mean, I did have had views, but I haven't actively traded many times over the last year. I think maybe 3-4 times at most. Looking at the GBP versus the USD, had a nice little bottoming out process here. Now, I would be very, very hesitant to buy here. I think people will soon start to book profits on people that bought here, and I think we may revisit the 61, or this, which is the 129.56 level. From here, it might potentially start to bounce and potentially go higher. But I'm personally, as I've been saying lately, still looking for something like this. I would like to see that little move to the downside, and then when we take out, so we have the high, when we create this high, whatever's created here, I think at that point, now some brave people will just wait for that move here and just try to do that. But again, I'm looking for, usually when you see like that, it should be going up, down, and then, sorry, that was not good. Ideally it goes like this: down, up, down, and then take out this high. Why do we want this to happen here and not here? Why can't we just do like that? Because the difference between that high and this low means that we need to have that as a stop. Whereas if we have a lower high here, then the stop loss is going to be smaller. With the smaller stop loss, the potential reward is bigger. The risk reward ratio just improves. And that's just what you're looking to risk versus what you're looking to lose. Dollar versus the Japanese yen is still holding up. Yesterday it looked like it was just gonna trade below 110.81, but at the end that level held, and we're dealing with an uptrend, so it's looking good. And I think we could potentially just hopefully see this bottoming out here. We're still dealing with some head and shoulders, and we're also still dealing with relatively boring FX markets, so you just need to have a lot of patience if you want to trade something like the dollar yen, even the euro dollar and GBP really. Gold, as I said before, potentially could be more fast moving and more interesting to trade. Here are crude oil prices, and crude oil prices, I think, as I said I think last week or something, I think the done their part, right? You might not remember if you were not following me at the time, but around January, beginning of February, I said, look, this is Brent crude oil. This is a massive head and shoulders with a left and a right shoulder in the head. And we had that break to the upside. I did the same setup as well for West Texas. And the difference between the neckline and this thing is about $11.39. We touched that perfectly here on April 25th. So this market has fulfilled its target. And now we sort of just need to wait for a new pattern to emerge. Another thing as well is that here, but also in West Texas, which is this market that we usually cover here, it might need some sort of a pullback. From the lows to the high, the market moved up with 56%. So if it corrects a tiny bit, it would not surprise me. Take fib from the very low to the high, you get these three fib levels. So realistically, we'll be trading at maybe 57.31 at one point. That would not surprise me. Now here though, I'm always hesitant to short into something that is so bullish here, because it takes a lot of time for the price to sort of figure out what it wants to do, and sometimes it's just a false move. It might just go upwards. Remember, this happened on what Donald Trump said, and Donald Trump always has comments about crude oil markets, but at the end of the day, I think we're still far higher than when he took office. So what can I say about this? Well, trade below 62.32, probably gonna trade lower. If not, I think we're just gonna trade sideways and potentially revisit that high. Okay, S&P, not a fun day yesterday. Well, actually depends on what you actually did. So yesterday, May 1st, on April 30th, and even before that, but let's just focus on the nearest or the closest sort of setup here. So just on the 30th, we said look to buy down here, and then the market, when we looked at the market yesterday, we're pretty much at a nice little level. From a risk reward ratio setup, we're at 2 times risk reward ratio. Would have been a good opportunity to book some profits. And then what I said yesterday, the market, if it declines down to something like 29.30, I think people would probably buy. However, we need to be a bit clever about these situations. So if you know that the Fed is going to have a statement coming out, then you wouldn't necessarily have pending orders to buy here unless you're 100% confident on your system. So what I would have done here, if I was wanted to trade this, is just to wait and see what happened. And clearly here the market went straight down. And the reason for the S&P 500 declining the way it did is because low interest rates is good for the stock markets. Now, if they do indeed go ahead and raise interest rates by the end of the year, then that could be a bit of a problem for stock markets. And I think maybe the narrative is going to change a tiny bit now, because people might say, look, we could potentially see interest rates, so and the market has gained quite a bit, so it could be something that slows down the stock markets. But it's always a bit of a balance here. Unemployment rate remains low. If non-farm payrolls remains low as well, remains strong, it could potentially cause the market to continue to go upwards. I think it's more if wage growth becomes really strong, and if inflation picks up dramatically, that I think maybe we'll see more dollar strength, and then people probably gonna be less keen on being long the market. This, from a purely technical perspective, is a bit like gold, crude oil. I think let it go down and it has gone down, let it rest for a bit, and then we'll see what can happen. If we take out the high, we can turn bullish. If we take out the lows, we can probably turn bearish. German DAX is doing very good, and it's holding up relatively well. Given what was going on in the S&P 500, I did think that we're going to have a bigger reaction here, but we did not. It looks like everybody's sort of loving German corporations right now. And you know what? It's not that unsurprising, because the ECB is going to probably introduce new stimulus to the banks by summertime. So, or later this year, really, summertime, for the fall. So this is supporting the market. What I would have done now if I was long is I would have reduced the stop loss all the way down to 12,238. That's what I would have done. What you want to do is up to you, but you have 1, 2, 3, 4, 5 lows at the same level, and it's very important to sort of tighten things up, especially if you bought on April 2nd when we highlighted this head and shoulders breakout. So maybe one could keep this for a little bit of a push here. We'll reach that target, but the long-term target remains here, which is 13,088, which is that target based on that head and shoulders that we've been sharing with you over the last few weeks. Okay, I think that's pretty much it. Guys, do you have any questions? Let me know. As well, today at 11, we're going to have a guest here. So it's a very funny and intriguing man, a strategist. It's a guy I met at CNBC's studios a few times. As you probably know, I do some interviews with CNBC Arabia, and this gentleman here, he's usually featured there maybe 2-3 times a month. At one point, I think it was even more. And he's more of a macro guy and also stock market guy, so he brings a bit of a different perspective to the markets than I have. And I think it could be interesting to just hear him out. So what we're going to talk about the Fed. I want to sort of pick his brain on that, and I'm going to ask him a bit about maybe Alphabet and Google. Sorry, that's the same company. Alphabet and some of the other, you can see, right, I don't really follow stock markets too much. But some of the big guys are reported this week. And I think as well, we're just going to talk about other things related to the markets. So join me at 11 here. I'm going to create an event for that. It's going to be very lighthearted, maybe 15-20 minute talk, sort of maybe listening to some alternative ideas that could broaden our horizons from a macro fundamental point of view. And you can, of course, always ask questions. So I got a question from Hi here. Are you still looking at the dollar index for a long? I got stopped out of that one, the dollar index, and I'm not necessarily looking to buy the dollar index right now. Technically, it's still trading upwards, right? You still have this head and shoulders, head, left, right shoulder, and we technically, it looks like we bottomed out here. Yesterday as well, you have a nice reversal candle. I might look into it, but I think we need to be picky on what we trade. because it's 50% of this is the euro. And guys, if the euro was a person, I would be very upset with them because it's so boring. There's nothing happening. But there are other stuff happening, and there are opportunities to buy dollars. Again, metals look good, and what you want to do is that here on our YouTube channel, you can check out. I actually published a setup that I might actually work with, and it's this one. Uh, what may happen, or it's about the Aussie dollar. I did that video yesterday, published it this morning, so I'll talk a bit about the Aussie dollar and the RBA. So here's a nice clear-cut little setup, and you can look forward to. And if nothing happens already, because we know from payrolls tomorrow, maybe next week on Tuesday, as the RBA is hosting a rate meeting. Okay, guys, 8 people watching and just 3 likes. Something's wrong here. Guys, don't forget to like the video and don't forget to share it as well. That will be much appreciated. The more you share, the more I care. So don't forget to share here, guys. It's a free presentation, and I am taking my time to do this. So if you like it, make sure you share it. And I know you like it because every day there's like 50 or 60 of you that watch it. So don't forget to share. That's really important. Okay, I think we're gonna wrap things up. As well, if you have any questions about ATFX, feel free to reach out to me via alejandro.zambrano@atfx.com. So we have very, very tight spreads for people on the Edge account, which if you want to have the same access with one of the brokers I used to work with before, you need to have 25,000 pounds or $25,000 or euros. Here, you get access to the same sort of spreads, if not better, for just 5,000 as a deposit. The deposit is what you use to trade, right? It's not a cost, that's just a deposit. Number 2, big difference here compared with where I used to work before, that we offer much more support. So anybody that does open an Edge account gets access to coaching. And we do that via Skype. That's a good opportunity. I used to sell coaching before, and I don't remember exactly the hourly rate, but it was 100, if not 250 per hour. Mostly because I didn't have time to deal with people on a day-to-day or like that close relationship. But here we have actually made space for that. So I have a few slots every week where you can book in. I provide you guys with help to develop a trading strategy if you don't want to have one. And if you already have one, we can talk about how to potentially optimize stop loss levels and take profit levels, how to work with money management, all of this to support you. And this is something that very few, if any, brokers do today. And this is all for free as long as you have that account and use it to trade. So check that out. You can learn more about these spreads here on the Retail Edge account. And about the education stuff, you just need to let me know and we can set that up. If you are in Europe, then the FCA entity is what you need to use. If you are in other parts of the world, then we do also have offshore accounts. And yeah, I think that's pretty much it, really. We also regulated in Cyprus as well, but most people open via the FCA, and other people that are in other parts of the world, except the US and some other countries that are not allowed to trade CFDs, we offer the offshore alternative, which looks pretty much like what you had before the ESMA regulations. However, it doesn't offer the same protection like the FCA does with protection for your account. There's more about this on the website. You can also reach out to me. Guys, thanks so much for watching, and I'll see you guys tomorrow. And let's get those likes up. Have a good day, and I'll see you guys very soon, hopefully, at 11 a.m. Thank you.